Hi everyone, and welcome to this chat with myself. Today we've got a special guest, Jack Talbot from Co.Credit. How are you, mate?
I'm good. How are you? Long
I'm
time
good.
coming.
Long, indeed. But thanks for taking time to have a chat to me today. Seen a few of your clips come up on social, so
For
I'm going,
sure.
what's going on
I
here?
was in I was in Queensland and a guy that I've never met before hangs out his window and he's like, Jack Talbot. I'm like, yeah. And
Yeah.
he's like, I see you on my reels more than I see my wife. I'm like, it's working.
That is awesome. That's awesome. I might need to get your social media
Yeah.
marketing person's details, right? Because
Pay them
that's
too
pretty
much
cool.
money, mate.
Yeah.
But
Excellent. Well, mate. Thank you for taking time to chat today.
sure.
I guess I'd love to have a chat about, obviously what you're doing right now, but just for the audience, basically, because there's a lot of businesses that come in, they want to chat to the Finance and Coffee audience, and then they basically were not part of the industry, if that makes sense.
Sure.
Whereas you are.
Yeah.
So tell me about yourself, mate.
So it's been a long time coming, which
Mm,
is I was previously a banker, went all the way through the Westpac group, Bank of Melbourne,
mm-hmm,
and did a lot of that sort of stuff in there. But specifically, we worked on this product, which was trail book lending. But that was way back then. Then I came out of there. I worked for Liberty for a little bit and
mm,
worked on an unsecured product with them.
mm-hmm,
Started and then left there, became a broker, which is beneficial for this sort of product, obviously, because you understand it from the customer perspective, but also from the lending perspective as well.
mm,
And that I still have that business. That business still exists, which is we specialize in cash flow lending, commercial, that sort of stuff as well, M&A.
mm.
So a little bit more out of the box, not quite so resi focused. And then I met my business partner on at a wedding actually in Thailand.
Okay,
Um,
yeah,
and
that's
um,
awesome.
and yeah, there was a spare seat next to him at a dinner one night, and I sat next to him, had a few drinks,
Mm.
and we came up with this. And 4 years later, here
Here
we
you
are.
are.
Yeah,
That's awesome. That I mean, a few of the best partnerships sort of happen randomly,
thank
right?
you.
Rather than looking. So, can you tell me a little bit about it?
Sure.
What, like a better word, why did you think you were gonna? Sorry, why did you think the broker market sort of needed something like this?
Yeah, absolutely. So we came together, and obviously my background is banking, and the process is not great, the system's not great, and you just kind of go through this process, and you're like, it doesn't have to be this way. Why
Mm,
why do we have to sell a product that the customers hate using? We hate using as well internally. There's got to be a better way than this.
mm,
And then, Aaron and I came together and said, why don't we start a lender? Which was, in hindsight, the most naive thought that we have ever come up with.
yep.
What we didn't understand back in those days is that product is only one half of the battle.
Mm.
The other half of the battle is fundraising, and fundraising to raise effectively a mini bank is
Not
pretty hard
easy.
work.
No,
Yeah.
it is.
So,
Yeah.
we're just like, we talked about it back then. We are like, oh, how are we going to find the money for this? Like,
Mm,
oh, don't worry about it. We'll come back to that. Like, we'll
yep.
circle back. It'll
Yep.
be okay. But then, we spent a lot of time on the product. We traditionally, what lenders do is they will build the offer first, and then they will sell the offer,
Mm,
but they won't necessarily have the product.
yes.
And that creates a lot of frustration generally for the customers, because if I put out an offer into the market saying I'm going to sell you this product at X%, whatever it is, and it's the lowest rate in the market, it's going to be great. There are big four banks that do this all the time. Get this loan, 6%, happy days.
Mm,
People will obviously engage in that offer, but then they try to go through the process, and the bank hasn't built the product necessarily. So then, while they offer the best rate in the world, rate is only one component of potentially, five, which is this rate, but this product, this process, this origination, this assessment, these ongoing maintenance after you settle, like all of these other parts that traditionally are overlooked when people are building products.
mm-hmm,
So we spent a long time, we spent 3 years to be precise, building the product before we even discussed launching it into the market. We wanted the product perfect. And that's how we've come up with the ability we want to assess these. Our SLA internally is 24-hour turnaround, and we want to fund these within 3 days. There
mm-hmm,
are internal metrics.
mm,
And we've got a lot of 5-star reviews on Google of people saying that's exactly what we've done. and they're happy. And that was the objective of what we're trying to do here, which is build a product that not only achieves the goal of what the broker is trying to come up with, which is building bigger and more profitable businesses, is the first thing. But the second thing is being able to deliver it to them in a way that they genuinely have a really good experience with it, and they go, I would do that again, and I would recommend it to the people that I know in the industry as well.
Yeah, that's fantastic. Yeah, because there is a lot of businesses that sort of, I mean, not just in the spaces, but also in the private funding space and so forth as well, that offer cheap rates, cheap fees, and then next thing you know, it's not there.
Yeah, correct.
So it becomes a bit of taste in the brokers, and usually, would you agree with me in a sense where this is an assumption. It's like a lot of brokers come in, they become successful, then they want to go to the next phase, which is growth. So one of the easiest way is to actually buy another business, and then so it's usually their first time looking at this type of product. So is that sort of one of the reasons why you sort of started this business as well? Because there's you spoke to other brokers and they came across this problem.
I guess it was a culmination of different things, which is A, I'd seen it before as a lender, so I understood it as a product. But B, then I saw it as a broker, which is the customer of it. And then because you're seeing it from two different viewpoints, which is how do I want this to work from a lending perspective? And then how do I want this to work from a customer perspective? You're able to put those two things together and then be able to create a process and a product that is considering both of those viewpoints at the same time. And I was lucky enough to have both of those based on my background. So, you look at it from a lending perspective and go, what would I want to see from a risk perspective if I was trying to assess this file? And we built a whole lot of tech around that. And then from a customer perspective, what would I want to see if I was applying for this product, and what would I want it to do if I was trying to use this product to try and grow my business? So putting those two perspectives together really gave us the ability, I would say, I'm biased obviously, that this is a genuinely kick-ass product. And the people that are using it are loving it, and it works. So rather than, a lot of people, you can have the dream of it working, but then execution is often a different part. To get the dream right and then to get the execution right as well, i.e. has the dream actually come into reality, into doing what it should be doing? And that is the hard bit, I would say, but that's what we have achieved, I would say.
That's awesome. So can I go back to your turnaround times then as well? So we're talking about 24-hour turnaround time-ish. So I'm assuming, this is, we're in 2026. Everyone's talking about, products plus tech. So you guys must have the tech background in behind there, trying to assess not only the customer themselves and their ability to service alone, but then also the book that they're trying to purchase, right?
Absolutely,
Yeah.
So my co-founder is Aaron Burry. He was the tech lead at Coinja and is nothing short of a genius, legitimately. People ask what the secret weapon of this business is, and it is genuinely tech. A lot of people will throw that sort of terminology around because it sounds cool and it commands valuations in the market and blah, blah, blah. The reality is this is genuinely a fintech business. And with the tech, we really sat down from a really first principles perspective and literally, whiteboarded out every single step of the process of how it currently exists. And then we said, which pieces of this can we improve? And which pieces can we just completely eliminate? And then from that, the goal was to be able to take as much data from the customer as quickly as possible and as easily and frictionless as possible, such that they can have a really easy application process where we expect for them to be able to do it within 10 minutes and we can provide an outcome within 24 hours. We don't look at the financials. We don't look at the P&Ls and the balance sheets. We just go, I know. That's when we're fundraising, that's the same reaction we get from the investors, by the way. But we managed to get through that. And from that, the goal is for the brokers to be able to go, that was quick and that was easy, and we've got the money and it's doing exactly what we thought it was going to do. And we've put it to work in our business the way we expected it to, and we can utilize it the way we want. We can give it back the way we thought we could give it back.
That's awesome.
So that was the goal.
Yeah, and I'm assuming because you're fairly new as well, you're very agile to change things if needed.
That's
Yeah.
absolutely the key here, which is we've built it from day one with the ability to, we planned what we wanted to do, 5 years down the track. We built everything with that goal in mind, such that we were building all of the bits back here so that we could bolt on the additional features and products later on when we wanted to.
Mm.
And from a tech perspective, even just stuff that you take for granted as a banker, which is, for example, just the ledger, just the core, the core banking ledger, which is just literally the ledger that defines how much money you owe, compounding interest, repayment mechanisms, that sort of stuff you just take for granted. You think that's easy. There is so much tech in there, that you just really underestimate when you're building these things. When you're paying back your home loan, for example, you don't necessarily think about how many components there are in the background as it's working. So when you actually step back and start to understand, not just from a core ledger perspective, how it all works, but from a valuation perspective on what you're talking about,
Because I'd assume that would be the traditionally that would be the biggest
bottleneck
hurdle. Yeah.
That is traditionally the biggest bottleneck. It's a very manual industry, I would say, at the minute. That gave us a lot of opportunity. Elsewhere you can pay upwards of thousands of dollars for a valuation. Then the problem that you have there is by the time you've paid an app fee, you've paid valuations, you're potentially already $5,000 down the road in due diligence fees. You haven't actually committed to the transaction yet. You haven't actually, you're already $5K in, and you only at that point able to actually understand what this is going to look like from a rate, repayment perspective. Is this going to work from a cash flow perspective relative to the trail that I'm going to acquire? At which point you then, you're already a long way down. And then I think psychologically people are like, well, I'm already here. I might as well keep going now. At which point,
even though they hate the process, they hate the product, like you said from the beginning, yeah?
Yeah, correct. That can be depending on which lender you're at, that can be a 4-6 weeks process over there. When I was a lender at within the bigger groups, this was you have to look at the home loans as well, and the credit cards, and kids in private schools. Like, it's legitimately a 4 to 6 month process. If you're trying to acquire transactions books, they move that quick.
So, they do.
So that's
or they want to.
Yeah. Correct.
Mm.
So that's I would say the valuation methodology of what we use, which is we can value a book in real time, so we can get one done in 10 seconds. And that, because we can move it quickly, that means we can keep our costs down. And if our costs are down, the customer's costs are down, ultimately how it works.
Yeah. So we're in, again, 2026, I said that. Now, I kind of feel we're at a weird time in the industry. And I say that in a sense where the OG brokers who started in 06, as an example, they're starting to think about exiting and so forth. Right?
Sure.
So do you find that the opportunities to purchase books right now are bigger than usual or smaller? Or
it's a really good
in
question. So we've had a deep look at the MFAA data is a really good place to look for this sort of stuff. There's today about 23,000 brokers in the industry. We project, according to the MFAA data, we would say somewhere between 10 to 12.5% of the portfolio churns per annum. Now, that is people exiting and entering, but in addition, it's also people moving aggregators. So the data is a little bit fuzzy, I suppose. What you're saying is absolutely correct, which is, I would say there's probably more red tape than there's ever been before. Particularly if you were to compare the industry to 10 or 15 years ago, it was pretty fast and loose back then. Since then, a whole lot of stuff has come in, like, the NCCP came in a long time ago, but like BID more recently, these sort of things. These guys that are 65 years old who have done it for 25 years are starting to get to the point of they remember the good old days.
They do.
So
they're like, therefore, what's coming next?
They're like, this is hard and it's getting harder.
Yeah.
At which point they're saying, I'm probably ready to exit now. I've probably had enough.
Yep.
That being said, there are a lot of books moving. I would say it's also probably the most competitive time I've ever seen it in terms of how difficult it is to acquire a book. The multiples of these are really starting to move pretty significantly, which is a hot topic. We should probably.
We're gonna. I was gonna sort of segue into that because traditionally I've been, back in my mind was the multiple was around about 3.5. at max. Now I'm hearing anecdotally that it's above that now,
Yeah,
a lot higher above
for
that,
sure.
right? So do you think it's other factors, obviously, government budgets and whatnot, and new compliance regulations that's going to come into the industry and so forth? Is that going to spook a few people, or?
I wouldn't have thought it's going that way. So I think more books are moving
Mm.
for everything that we've just talked about here. The way Co.Credit works is we will value the book at anywhere between 2 to 3.5 times on what the book generates per annum.
Mhm.
And then we'll lend up to 70% of that value for an acquisition.
Yep.
We'll lend 50% of that value for a working cap facility for business purpose lending. So on the basis of like an acquisition and like in terms of multiples and what we're talking about here, is that the right multiple and what are we seeing in the market? We do see them for as low as, like 2.2, whatever.
Mhm.
And I've seen them go up as ridiculously high as 4.8 is probably the,
That's pretty
sort of
ridiculous.
almost touching 5 times now.
Yeah.
And people will go, "Ooh, well, that's a long way up there." And we'll talk about shortly what drives all of that sort of stuff as well. But I think the bit that's interesting is, what is driving that is two things. First of all, this is becoming a more mainstream way of growing your business. 10 years ago, it was quite nichey. Even 5 years ago, it was quite nichey. Not many people can access that level of liquidity because not many people like what we are doing really existed. And you really had to be quite well versed in, probably how M&A works as a more bigger concept. And you also needed access to the capital, which means traditionally at that point, you probably need to get it out of a major. Majors generally won't get out of bed for a facility less than $3 million, at which point, a $3 million facility on a trail book acquisition, these are big businesses buying big other businesses, which means your standard mum and dad broker who wants to buy like $150,000 book they won't be able to engage in a transaction like that. So what's happening now is twofold. First thing is this is becoming a more mainstream idea as people like us are trying to socialize it and show that regular people like you and me can just do it. That's the first thing. And the second thing is our minimum loan amount is $50K, whereas that's like it's a zillionth of what the banks will get out of bed for. Is the first thing. But the second thing is, as we are creating this mainstream product with a goal to put more liquidity into the market, my hunch, in the same way that the housing market works, is if you put more cash into the market, it is going to send the value up. So just in the same way that, our good friend in camera, Mr. Albanese and Mr. Chalmers, different topic, let's talk about them another day.
Yeah.
But, they put all of these incentives into the market on the demand side of housing. That is creating, ironically, the reverse of what they're trying to do, which is the housing pressure is coming up, not going down. So I dare say, as we make this a more mainstream idea and push more money into the market and let more people use it easier, I dare say it's going to push the multiples up because it's easier and it makes sense.
And this is all good. Then the more people know about you, then it pushes the books up. Everyone's technically happy, right?
That's the hope.
Yeah.
And just talking about multiples for a second, a lot of people will be like, "Ooh, these are getting expensive." I think acquisitions in terms of, and this is really probably one of the main reasons we entered this market. I think acquisitions, and I'm looking at this, remember, from the broker lens because I was a broker. These are the easiest and best ways to grow your business quickly if you're set up properly. That's the caveat. You have to be set up properly and you have to have the right processes in place. But in terms of you have got the ability to execute a transaction whereby you are buying income, and the income that you buy is going to be will support the principal reductions of the loan that you take and the interest. So the trail will pay the P&I of the loan for you, and it stands up on its own 2 feet from a security perspective as well. So we don't even need to take a property, for example, in this transaction. So it's self-sustaining from a security perspective. It's self-sustaining from a cash flow perspective. You've just bought potentially hundreds of clients, which you're going to get on the phone and make sure they're on the right product and potentially rewrite them if they're not on the right product, which means you're getting the opportunity to write more upfront commissions, and then also maintain the trails. Like this is a no-brainer in terms of being able to compound the growth of your business quickly.
Yep. That's awesome. So it's almost like money for jam, almost.
I would say it's better than jam.
Yeah. So can I segue a little bit here?
Sure.
Because
please.
we're talking about acquisitions and for growth and so forth as well. So I think I would assume most of the audience will be thinking, okay, I'll need this to buy another business. But when you said before working capital, we're talking about, hey, I'm running a business. This is my trail per month. I need a little bit to do something else.
Sure.
Is that what the working capital components for, or is it?
Yeah, for sure. So the goal of everything that we've built in this business, again, is genuinely to help brokers build bigger and more profitable businesses. And working capital, i.e. liquidity within a business, is generally what will hamstring an SME business the most, which is the ability to access capital quickly and easily and be able to utilize it the way they want to be able to utilize it. Working capital, therefore, is really important in something like that. So for a few reasons, you can utilize that. For example, if you already have a decent business, you're trying to potentially pick up a new broker, for example, or you want to pick up new staff, you want to put them in today, you might want to be able to pay them a wage, for example, to get them spinning because they're not quite confident enough. For example, if you're trying to, I've done this myself, trying to pinch a banker out of the bank, for example, they need to be sort of de-risked a little bit. So you need to kind of be able to set them up with wage. By the time you put them in, the business, day one, get them accredited, get them on the credit license, get them set up on the systems. By the time they actually write a deal, they don't get paid for that deal until the following month, on the 25th of the following month. Correct, right? So you're potentially looking at a lag there of about potentially 4 months. So they need to be able to fund that cash flow gap using some sort of debt tool, probably, or cash flow if you've got it. But it's cheaper to fund it with debt. If the benefit of what we run on the working cap product is we give you the ability to draw down today, and we give the ability for you to be able to pay the money back whenever you want, with no early termination fees, no exit fees, no discharge fees. Traditionally, what happens in the industry is they make you commit to the money, which means you take it on a 5-year term. If you want to exit at the end of year one, you'll pay 5 years of interest, which is in that example of what we're talking about here, which is this 5-month gap that you need, but you don't want to take a 5-month loan because your repayment's going to be enormous. You're going to put it over a 5-year loan, but you want the ability to come out after 5 months. If you are fixed into a term, it doesn't make sense at that point to take this product. Whereas if you utilize it in this way, which is a 5-year loan term with the ability to pay back partially or fully at any time, then suddenly it's a flexible product. Suddenly you can use it as is what we're talking about, which is the ability to draw it down when you want, give it back when you want, which means you can use it the way you want to. And that means you've got the ability to genuinely use capital to grow your business, which means instead of us telling you how the capital should work, you can use the capital how you want it to work, and you tell us how you want it to work, provided you pay back.
Yeah.
So that's what I would say there.
So is the percentage on that different? No, I'm not talking about the rate, but say, for example, when you were trying to acquire a book, is it 70% of the lend, right?
Yeah. So, in terms of a max LVR.
Yeah,
correct. So we'll go to 50% on a working cap loan of the valuation that we talked about before, which is anywhere between 2 to 3.5 times what the book generates per annum.
Okay.
So you've got a book that potentially kicks off $100,000 a year. Let's just say round numbers, 3 times. That's $300,000 value, we'll say. For a working cap, we'll lend $150,000 against that book on a 5-year loan term.
That's pretty awesome.
It works pretty well. It's good. It's good. And somewhere where it is working really effectively at the minute, our good friends again in Canberra driving some good ATO debts at the minute.
Yes.
Now we all whatever. We hate the ATO. I'm going to say it if you don't say it.
Well, look, everyone who runs a business, I mean, that's the whole point of employing an accountant, right?
Yeah.
Because we don't want to pay tax. We're trying to minimize our tax.
Yeah.
But then obviously we've had the whole COVID things, and now the ATO was actually being a bit more strict in terms of how they collect that debt, right? So this is where a good case of being used. Yeah.
Super effective because
Mm.
what they do is they are charging you an interest rate on your outstanding debt today with the ATO of 13%, non-tax deductible, which means by the time you make it tax deductible,
Mm.
it's somewhere about apples with apples on
Yep.
debt. It's about 18-ish% is
Yep.
where you're paying roughly. So they will max you out on a 2-year loan term if you take debt with them and you're paying about 18%. What we will do is we will take out the ATO, but instead of putting you on 2 years, we'll put you on 5 years.
Mm-hmm.
We'll free up your cash flow.
Yep.
And beyond that, we give you the ability to repay at any time, which means you've now just taken your loan term from 2 years to 5 years, but you can also have the flexibility to give it back whenever you like, which means the guys that are running, just trying to pay the ATO off in 2 years and can't actually run a business because they've got to pay the ATO down, gives them a bit of space to open up again.
Yep.
And then start to focus on building the business again.
And it's tax deductible.
And it's tax deductible.
That's brilliant, actually.
Yeah.
I didn't even think about that before. But then again, I'm not an accountant, so I just run a dumb Facebook page. So now I'm going to be cheeky because obviously, we're talking about a short-term debt, which is 5 years. Most businesses, in theory, should be able to pay that out sooner.
Mm.
So what if I paid it sooner and I want to keep going? Do I apply for another loan, or is there something that, because something's akin to a master limit type of product?
It's a good question, Dien.
And I've been cheeky
And
here because it's, yeah.
So we haven't released this formally yet. We talking about this? Yeah, we'll talk about it. Okay.
Yep.
So what we've put together and the bit that is probably the most requested feature is line of credit, revolving facilities. They make perfect sense because if you have a cash flow gap in your business, which you do and you can have as a broker from clawbacks, the issue that you have is if I have, say, a commission today that should be coming of 20 grand and I have a monster clawback that is 25K, I will see $0 from the aggregator today, and I will have to wait another 30 days before I see $1 come down again. At which point, and in this example, that one as well is going to be hit by 5 grand as well on the still paying back the previous clawback. So you're potentially not seeing $1 out of the ag for 60 days. So you need to cover that gap, and that is where we have introduced and we are piloting a new product, which is line of credit, revolving facilities, approved up to a limit that you can draw down on in real time, only pay interest on the facility that you draw from and pay it back when you want to. And as I said, it's not like some of the other guys in the market that it's not quite a revolving facility, that is sort of more a multi-drawdown term debt facility. This is a proper revolving line of credit facility that brokers can implement into their business, which gives them the ability to cover cash flow gaps. And the goal is we want to give everyone in the country everyone can have it. And then the ability is to just be able to use it when you need it as required.
Yeah, because you see on the community chat probably at least once every 2 weeks that someone's had a bad clawback experience, right?
Yeah.
On top of that, you get hit by BAS.
Yep.
Right. So people forget about BAS, and then if you are employing staff, then there's super, there's all those other bits and pieces that can hurt you. So that this facility is actually pretty good.
Yeah, absolutely. That's exactly the goal. Which is again, this is one of those things where conceptually it's really simple. Particularly my co-founder, who is, like, as I said, a wizard on tech. He will be the first person to tell you, not that easy.
Yep.
It is conceptually simple, but extremely difficult in the background to be able to have a facility that is a proper come and go facility where you can literally draw down and pay back in real time whenever you want. And then obviously you've got compound interest, which is keeping up in the background as you go. Yeah. So I think it will help particularly in these cash flow. If you're in a more cash flow lumpy business, if you're running bigger transactions but not many of them, for example, you've got ATO, as you've said, you've got clawbacks, that sort of stuff.
I'll be honest, I think that might be perfect for the broker in the 2 to 5 year period where they've made it because they were past that 2 year.
Yep.
But they're going to be constantly battling that part.
Yep.
Yeah.
Yep, spot on.
Yeah.
So that's the goal.
There you go.
That'll be good.
So I look forward to seeing when you actually launch it for real, and we'll.
It's
Yeah.
it's pretty much out there now. We haven't hard launched it,
Mm.
but we are soft launching it as we speak.
Yeah.
So that's all good. That's happening. It's exciting.
Fantastic. So for you, I mean, for the average broker going about their day, how would you want them to go? I need to give Jack a call about my particular problem.
Yeah, for sure. So there's a few things here. When we're looking at acquisitions, it can be potentially a pretty daunting process if you haven't been through one before, and that is totally understandable because although we're not talking about BHP acquiring Woodside here, but like we are talking about. It's still basically the same thing, except the numbers are much smaller. So it can be intimidating. And a lot of the questions relate to how do you dock this? What does a structure look like? What should I be looking for when I'm like purchasing a new book? Are there any dangers to any of this sort of stuff? Like these are sort of the questions that we're getting asked.
Mm-hmm.
I just want to take you through a few of these. So we've got one client she is an absolute jet. I've never seen someone this good. And this is a structure that she used, which I thought was really clever. The answer is, from a structuring perspective, there is no right or wrong way to do it. There is no like uniform way that everyone can follow and it will give you a great outcome every time. It is ultimately what's going to work for you and what's going to work for the person selling the book. But the biggest thing I would say that is most important is the transition of the clients from the old portfolio into the new portfolio. Because while you're buying the annuity stream, and that is ultimately what people are focused on when they're doing these deals, that is only one component. You're buying the annuity, but you're also buying the clients. And the clients are super, super, super important because that's your true income that goes on into the future. So the goal is warm transition from old portfolio into new portfolio. And how do you do that? And this is the one that I saw that I thought was really good. She bought a book, probably paid a pretty toppy multiple, so probably a mid-4. And then what happened was did a deal with the vendor. And often what happens is vendors will not, they've built these businesses for 30 years. So that while the idea of selling this business and then generating, $500,000 or $1 million or whatever, and going and sitting on a beach sounds pretty cool.
I'm so sorry about that.
Yeah, is they freak out as they're getting ready to go because they're like, it becomes final, and they're like, "Oh, I've done this for 30 years. I'm not going to speak to any of these guys anymore. What am I going to do every day?" So they kind of have this little, at the last moment, a lot of them will have this sort of like, "Oh, I don't know about this."
Yep.
And I think this is why this model works really well, which is you do a deal, and in this case, the agreement was that the vendor stayed in the business for another 12 months. They went on as part-time. Every deal that they wrote, they would get a proportion of the upfront.
Mm-hmm.
The other proportion would go to the buyer, and all of the trail would go to the buyer. That does two things. First of all, it keeps the vendor around for a bit longer, gives them sort of a bit of a chance to sort of ease into that retirement period, rather than just going like straight on, where they like tend to almost have a bit of like it's jarring. Is the first thing. But the second thing is that is the best way to get a transition over from the old portfolio into the new portfolio. You go, everyone, this is blah, blah, blah. She's great. I've partnered with her because I've got confidence that she's going to look after the clients. I want to introduce you slowly over the next 12 months, but she's the girl. She's absolutely all over this, and she's going to look after you, and I'm confident of it. Now, I would pay a supercharged multiple to have that happen, because if I take the trail over, which even at that multiple, you're still largely being offset, like that is largely offsetting the debt associated with buying the book is the first thing. But the second thing is that warm handover. If you've just bought 200, 300 clients and they are warmly handed over to you and you retain them for the next 10 years, that is gold. Like it does not get better than that, in my opinion. I'd pay 5 times for that on the right book.
Yep.
Because ultimately, if you're paying a 5 times multiple, let's just say, which is a ridiculous number, but let's just go with it. Um, you're
Well,
eff- you're
You
effectively
don't know.
yeah, true.
Right. Yeah, because I saw that fall on a bit, and I'm like, what?
Yeah,
Here we are.
yeah, exactly
Mm.
right. So if you pay that number, you you're effectively averaging. You're betting that the trails will stay on for at least 5 years is the first thing. But that's
Mm.
just assuming that's just the trails that you're buying today.
Mm.
That disregards all of the upcoming upfront income that you get as a result of buying this book. It disregards the referrals that will come from that book, referring partners that come with that book.
Mm.
Like I've got another client, also female, also a weapon, who, again, models it all out, makes assumptions on the level of the book that she'll be able to churn. And then not just that, also picked up probably 3 or 4 referring partners in there as well, accountants.
Mm-hmm.
Warm handed over from the previous broker, will call me and say, best thing I ever did. I just want to line up another one. I'm just trying to find the right book now. And now we'll try and execute a second one within 12 months.
Wow.
So it works.
Yep.
But to come back to what we were talking about previously, which is what's the hard part of this, or where are the traps? If you're a business that is one person, you have no back office, you have no potentially support, you try and bolt on a massive book over the top of you, and you're not ready to stretch or flex because your processes aren't appropriately set up, and then you can't appropriately service these clients, that's where you can get into trouble. And that's what I would say, don't run before you can walk, which is get your business set up appropriately such that you have the resources. Make sure that, let's just say that you're running it, say, you've got a couple in the back office, you might have another broker with you now supporting, and you start to figure out, my biggest problem now is I haven't got enough traffic. This is a good time to go and buy another book, because the acquisition strategy effectively is bolstering up your lead flow, but you've got places that you can integrate that traffic into, if that makes sense.
It does, yeah. As you're talking, I'm going, there's an ecosystem here.
Correct.
So, you know, do you offer business coaching, or do you offer, say, what do you call it? A marketplace for books as well, or are you just lending and that's it?
It's definitely something that we are exploring. There's, in terms of marketplace, there is definitely an opportunity there, because in the same way that we built this product, which is we wanted to fix problems and we wanted to fix legacy issues that exist in the industry, there appears to be the same legacy issues in the buying and selling of books, which is,
it's not very public. Sorry, I'll just say that now.
It's not that it's not just public. It seems to be a bit of an old boys club, which is, there's a lot of secret handshakes. There's a lot of I like you more, so we'll do one over here, and we might see if we can tell this person to up their bid a bit, and we'll use that to leverage this person to give us a better bid over there. That person now feels like they've been screwed. They had no visibility. They didn't really get any of the data. It just feels a little bit sort of opaque, and people don't really feel like they're getting a fair shot. The people who win out of these transactions are traditionally the people that are selling. They feel like they've got a good deal. A lot of other people feel like they're getting a crap deal. And that is probably something that we have identified that we think we might be able to fix. I think there's still ways that you can do deals with people whereby the vendor walks away feeling like they've had a really good day, but also the people purchasing feel like they've had a good day, but not just the people purchasing, the people who had a crack and were unsuccessful still can walk away from that transaction and feel like, I missed, but I feel like it was legit, or it was fair. I think there's a lot of sort of secret deals that happen, which I think we can shine a bit of a light on. We can probably give more transparent data into the market is the first thing. We can probably make it more visible so that more people can see it. Now, there's pros and cons to this, obviously. The pro is everything that we just talked about there. The con is, as we make it more visible, you're probably going to pay a higher multiple. So, that kind of, but ultimately, a marketplace is, the definition of a marketplace is equilibrium between buyers and sellers, which means if you've got the most people you can have in the marketplace on both sides, in theory, they should be selling for the perfect price all the time, because it's hitting that equilibrium more often, if that makes sense.
It does. I mean, because I've been, I've been looking at this from a I tried to be agnostic, but I also thought it was kind of weird, where it's kind of like, well, there's no, realestate.com type of situation for broker books.
Yeah.
Then you got, some aggregators saying you can't sell your books outside the group. And I'm going, well, wait, then how does, how does one know truly how much a broker book is actually worth when if the broker is theoretically earning the same? No,
Yeah,
same
totally
upfront,
agree.
same trail. So why is this more than another? Which
Yeah.
sounds stupid, right?
Yeah, and that's the process is a bit interesting sometimes, I think, where, they'll say they don't really give you any information to do due diligence and then say, well, throw us a bid and then we'll consider you. And you're like, well, what am I bidding on? They're like, oh, we'll give you that data after you bid.
Yep.
And you're like, but I don't know, like you're asking me to put a bid on a house that you're locking the front door of. I'm not allowed to look through until I bid on it.
Trust me, bro.
Yeah, yeah.
Right.
So I think there's a few opportunities in there, again, with the goal of creating a more transparent marketplace and a position where all stakeholders, which is aggregators, buyers and sellers, all achieve the same outcomes at the same time, which is there is a way to get everybody happy such that, everyone gets the outcome that they're looking for.
Yeah.
Which I think we've got a long way to go in the industry to make that happen. But we've got the tech to be able to build something like that. We're looking at potentially building essentially the eBay of trail books, which it's a beautiful like heads up display screen, really beautifully visually shows all of the metrics that you would want to see on a book. Far more than what you can get today, and a live updating leaderboard where you can bid and transact in real time and watch as the bids are growing over time. Now, again, it's probably going to send a rocket up valuations.
It may, but like I said, at the end of the day, to me, my friends are the brokers who are starting out, and you're building something to sell it.
Yeah.
Right? So who wants to sell it for a shit price?
Yeah, exactly right. I agree with you, and that's the way it should be. But ultimately, the market is the market. You go, well, the multiples are high, but ultimately, people say, well, what's this worth? The answer is what someone's prepared to pay for it. That's what it's worth, and vice versa, which is what someone's prepared to sell it for. Like that's what they go for.
I personally think it's a great thing to buy.
Yeah. And the reason why I think it works so well and why this debt products work so well is we'll use some numbers on this. For example, you buy a trail book that kicks off $100,000 per annum, whatever that is, $8,300 a month. Now that is, if we value that at round numbers 3 times, that book's worth $300,000. That's the amount of debt that you need to raise to buy that book. On our loan product, assuming a whole lot of like stuff, but assuming a 5-year long term, your principal and interest repayments on that are probably going to be about $7,300 a month. Whereas the trail is generating $8,300 a month. So in this example, you're $1,000 cash flow positive. You haven't had to contribute any other additional security beyond the book itself. So it's standing up from a cash flow perspective and a security perspective. And then you've also bought all of the customers that come along with that. Now it's important to understand that $7,000, $300, $400, whatever the number is, that is P and I, which means the annuity is not, the trail is not just paying the interest for you, which is the cost of buying the debt, buying the book. It is also repaying the loan for you. Like it just doesn't get better than that. And the fact that you haven't kicked in a property and you've also got all of those customers that's come with it, like this is just purely looking at it from a numbers and annuity perspective. Now you have a look at it from a people perspective, which is the customers that you've got. You're calling all of these guys and you're like, hey, are you on the right product? Should we get you a better product? Because it's going to be, the market's changed since you wrote this loan. You rewrite that loan. You get another 65 bips on the rewrite of the loan. If you churn potentially 20, 30% of the book in the first 2 years, this is just cream at this point. The loan is amming down. It will am on a 5-year period. You probably, if you're doing everything you should be doing in that book, you're probably in a position to go and buy another one within the next 2 years. And like your business, if you model out what that looks like, and hint for everybody watching, you can download an acquisition model from our website, Co.Credit.com.au. if you have a look at that model and model that out relative to just, the organic way, which is no acquisition, just, knocking on
Just
doors and writing loans,
Yeah.
the curves are like this. Like it's a totally, because you're using the same way that you're using debt within a house, for example, you're putting in a 20% deposit and getting 80% debt, but you're seeing a gain on 100% of the asset. So this is obviously the power of leverage.
Yep.
And that's what we're bringing the power of leverage into this asset class, which is going to mean you can build way bigger businesses way quicker.
Yep.
That's the goal.
There you go. Okay. So let's do it like a layman's term, right? So I'm Mr. Broker.
Yep.
I'm looking to I know Bob. Bob's probably exiting the industry, or he's had enough, or whatever. I don't really care.
Yep.
But Bob has this business that I want to buy.
Sure.
All right. So I would talk to Bob. I would probably we'll haggle because I'm Asian. I'm always going to haggle anyway. Yeah.
I haggle too, by the way. I'm not Asian.
I haggle really badly because I grew up overseas, in New Zealand. So, but anyway, so walk me through. So I would then get Bob's database, his RCTI and so forth, and then I'd come to you.
Sure.
Yeah.
Yeah. Good question. So, essentially, what you're doing is you're going to speak to Bob, and the objective of what you're trying to achieve is you want to. Your goal is you want to buy Bob's business because you want Bob's trail income is the first thing, and you want Bob's clients.
I do. Yep.
Bob wants you to buy his book because he wants to be paid out for the trail, and generally you can sell your trail for around, call it round numbers, 3 times what it generates per annum is the first thing. So Bob wants to get paid for that. And the second thing is, and this is the bit that sometimes people forget about, is Bob wants to make sure that his clients are looked after because he spent 30 years building this book. And, half of these guys are probably his family and friends, and he doesn't want to just like punt these guys off and just go, it's someone else's problem now, goodbye. So these are the 2 things that we're trying to get together. From a process perspective, what you want to do, you're right, you want to haggle, as you've appropriately said there, is the first thing.
Or do we haggle first, or do we get the data and you check it out and then we haggle after you've valued it?
Yeah, so what we would do is, so you guys should probably haggle.
Haggle-ish?
Haggle-ish. Put together it's a good word. Yeah. Put together a heads of agreement, which basically just you put down on paper essentially what you're thinking, which is, this is what I'm prepared to sell you. This is indicatively the multiple that we're talking about. Tip for people, doing a private haggle is far more effective than buying these off like an auction type place for the record, because as soon as you bring in an auction type place, the multiples are going to skyrocket. That's the first thing. What I would say is, because we move so quickly, we move in 24 hours. So we can get them done fast. So what brokers traditionally do, they'll just sort of run it like a home loan in their mind, which is, I need to get finance first and then I'll do the haggling. Like, nah, do it the other way around, which is do the haggle first.
Yep.
Get into a position where you think you're ready to purchase it and you understand the numbers and all that sort of stuff. Then come to us, because then we can actually start putting it all together in the background, because we've already got sort of vague little bits around, who's buying it, how much money they're going to pay for it, how we're going to structure it, that sort of stuff. It's much quicker and easier when you just go bang, bang, bang. Whereas if you come to us and you're like, I think I need to figure out if I can finance this first, and then like, maybe after I understand that bit, then I'll go back and we'll have another conversation. Don't do that. Heads of agreement first. Confirm that you're going to be the person that's going to buy it is the first thing. That the heads of agreement does that. And the second thing is get an indication in there of how much you want to pay for it, how much cash you've got, all that sort of stuff. Then come to us. We can put it together in 30 seconds.
Okay.
That's what I would say.
So for the average, if we compare it to a home loan, a broker's going to go, right, so maximum LVR is, say, 95 for purchase, then they add an extra 5 on top of the purchase price for costs and so forth. For a broker trying to, top of their head, trying to buy someone's business, they'll come to your business and they'll know that it's 70% land.
Yeah, correct. So,
yeah. So
this is what I'd vaguely keep in the back of my head when I'm trying to buy another book, is the way we will do it is Co.Credit will value the book that you own and the book that you're purchasing. we will value each of those two books anywhere between 2 to 3.5 times what they generate per annum.
Mm-hmm.
Add them together, we will lend to 70% of the combined value of the two.
Yep.
So you think about this just from a security perspective. If I've got a $10,000 trail a month and I want to buy a $3,000 trail a month, that's going to work every day from a security perspective.
Yep.
If I have a $10,000 trail a month and I want to buy a $25,000 trail per month, not impossible, but you can see that like it's a very different proposition at that
100%.
point.
Yeah.
That's why I would say, and then you'll come to me first. You haven't really executed anything or blah, blah, blah. There's too many hypotheticals and we go, well, we can't value their book yet because they may not be comfortable to give you their data because you're not far enough down the road yet. So what I would say to you is do a heads of agreement, figure out that you're the guy or the girl. You're shaking hands, you've vaguely got a multiple. At that point, the vendor is probably going to be comfortable enough to give you the information that you need to be able to understand the value of the security. You can then bring that to us. We can value that book. We can value your book. And then we can spin everything up, get you a conditional offer. Then you can go back and go, I know in the back of my head what my max borrow is, at which point then I can now speak to you. I know that I can get up to a 3.9, for example, in the back of my head. I'm going to tell you 3.5. You're going to tell me 3.7, and I'm going to say, cool, let's go.
Okay.
That's generally how it's going to work, I would say. As I said, there is no right or wrong way to do these. Like the process is, what I would say is, have a solicitor or someone similar with you. Have an accountant with you. So here's a tip for young players, which is if you are trying to buy the book and you buy it as a going concern, it will be GST free. So what that means is if you are buying someone's business and the business is coming to you, which is potentially the brand, it's potentially the phone number, it's all of the clients, it's the trail, that's considered a going concern, at which point you will be GST exempt on that transaction. Now, do your own research, speak to your own accountant. This is not financial advice.
Yep.
But like all of those things, I would say.
Yeah, that's brilliant.
So, potentially you're on a 400K acquisition, it's 40 grand you've just saved there.
Yeah.
You're welcome.
Well, there you go, because there will be some brokers who are in the industry still starting out new. They go in all these award nights. They're saying, "Oh, how did this business go from that to that?"
Yep.
Like almost in a short space of time. But
sure.
they're probably using something like this
for sure,
right, to expand.
I would so we've got a client on our book who I keep on thinking about. She's got a really solid business, many brokers in there, many offshorers, many support. That is the process set up. That's the machine set up. So, she spent, to use a metaphor, she spent 5 years building the Ferrari. The Ferrari now just needs fuel and a racetrack and it will run.
Yep.
So whereas, she's now got the ability she's acquiring books. It has got enough scale, this business, that you can jam in heaps of traffic into it and it will just churn it through because it's already built big enough. To use that metaphor again, you buy an acquisition that's too big, you haven't set up the car, you're potentially, trying to drive the Indy 500 on a tricycle. Like your wheels are going to fall off.
And that's why you never seen an Asian driving in the Indy 500. But that's another thing altogether. I'm okay for you to keep that. I thought that was a joke, so I didn't mean to be racist to my Asian brothers out there and sisters. But I get what you mean. Yeah, because there is the walk before you can run. But you make sure that you've got the right shoes on first.
Absolutely.
Yeah. So we're in. Again, I hate to use the 2026. Everyone's talking about AI. Everyone's talking about these special texts and so forth, right?
Mm-hmm.
So we're seeing these people are building these agentic AIs, trying to and scraping people's data, and then mass calling, mass emailing, and so forth.
Mm-hmm.
How do you see that as potentially affecting a broker's book? Do you think people are because we did talk about the trust factor, right?
Good question.
I'm not gonna, so I won't talk to someone or message someone I don't know.
Mm-hmm.
But when the AI is getting pretty sophisticated,
mm-hmm.
and you start to potentially engage in those other businesses, do you think they have the potential to minimize the value of a book?
Okay, so in terms of AI, yeah, I think your question broadly relates to how is AI going to affect the industry and brokers.
Yeah.
So there's a few things there. I personally, now famous last words potentially, I
Anyway, go.
I think from an AI perspective, um, I think from an AI perspective, we are brokers will be very difficult to be replaced. Is for two reasons. Uh, First, clients need to feel like when they're speaking to a broker,
Mm.
they need a human element to them because you can't, with AI, you can't replace the human element of trust or the feeling that someone is hearing you
Mm.
and understanding you and is protecting your interests essentially. A computer, you just don't get that feeling when you, and that's, I would say, the reason why a lot of people are going to brokers in the first place over a bank, for example, is you know, the MFAA data recently said they've just released new data, which is now 81% of all resi home loans are written through a broker. That is a huge number
It is.
and growing month on month
Yeah.
all the time. Hasn't had one decline in the time that that data's been collected. They are electing to see a broker because brokers are doing a fundamentally good job at connecting with the client. And the client not only feels like they're getting a great deal, but they are trusting the broker to do the right thing. And I think that's huge testament to the industry, which I absolutely love. To come back to your AI question, which is, will AI wipe out brokers or lending more generally? I don't think so. Even if you gave AI the tools and the ability to give you the same outcomes,
Mm.
this is not, you're not applying for, a credit card. Like I can see it happening for a credit card. You, your home loan as a customer is your biggest asset to 99% of people. Like your house is not only is it your biggest asset, but you're emotionally tied to it because it's where your family lives.
Mm.
So you really emotionally don't want to screw this up because it's very important to you. So AI, you just go, AI bot comes to you and like, oh, I'm going to sort everything out for you. And you're like,
Mm.
but do you care? Like,
Mm.
is this, how do I know this is the right thing? Do I feel good about it? Do I feel like my family's safe? Do I feel financially I've made the right choice? AI, I don't think, is going to be able to do that at least anytime soon. That's the first thing. The second thing is the worst thing and the best thing geographically about Australia is technologically, and particularly just from the way the financial system is set up in Australia, APRA, the government, it is an oligopoly. APRA likes that because they're easy to control. And that means from the perspective of keeping the lending system safe, for example, DTIs, stuff like that,
Mm.
max LVRs, they're all in this little bucket. It's easy to pull levers to keep all these guys in one spot. If you've got some mega AI business, likely will come out of the States somewhere and says, oh, we're going to penetrate the Australian market and we're going to revolutionize lending in the country. The
Mm.
Australian government's going to go, no, you're not.
Mm.
You're not coming in here. And because they don't want that loss of control. You've seen that with as even stuff like Bitcoin and that sort of stuff coming over. The government is very, very trepidatious in terms of how quickly they let these new technologies come through. Now, the benefit of that in this country, and maybe the cost, depending on your viewpoint, is it's going to be difficult, even as the whole world is moving in that direction. Australia traditionally, in these sort of financial products, will be behind because it takes so long to get through us from a regulatory perspective. I'll give you just one quick example of that. Apple Pay.
Mm.
Apple Pay took such a long time to penetrate the Australian market. ANZ had it for about 3 years, I think, before the other banks got it as well. That is because there are so many, the government knows that once Apple gets their little tenterhooks into the system, they're going to lose somewhat of control of essentially the merchant facilities and the interchange and that sort of stuff because Apple now is effectively clipping every transaction. The government is therefore sitting there saying, well, we don't know if we want to let Apple into the ecosystem because then we're going to have to pay them or they're going to get paid instead of us getting paid ultimately. So we're just careful on stuff like that. It's just one example of where they're just like, we'll just hold everything up a little bit here. And I think
Yeah.
that's going to be relevant in financial products with AI,
Okay.
particularly.
Yeah. So then that's for you brokers out there, sort of building your own agents. Just be careful. It sounds good, and it may improve your process and so forth. But then where's the data sitting? Because that can then get you disaccredited.
Yeah, it's a good point. There's a lot of people doing that, which is using AI agents, throwing in mountains and mountains and mountains of data into these things. We're probably not quite there yet in terms of understanding what these things actually are doing.
Or where it's going.
I don't know,
That's the worst bit.
how
Yeah.
much you know about Sam Altman.
Mm.
If you do know the guy or you don't know the guy, I'd probably have a look a little bit further into his background, start to figure out whether or not you want to give him your passport or your ID. I don't
Yeah.
know.
Yeah.
So
Mm.
yeah, I think we are still pretty early in terms of understanding where all that's going. And you probably can write credit files in 30% of the time
Yeah.
by using these things, but I would say be careful because we don't know where that data's going.
On the flip side, you can actually use them once you acquire someone's business to basically then, contact your clients, your new clients.
Yeah,
Right? So, but anyway, that's another
another foray.
Yeah.
Yep.
Um,
All right, let's talk about book multiples quickly.
Okay.
This is really relevant. A lot of people will ask this question, which is, how do I get the best multiple on a book? What am I trying to do? I would answer that question by putting yourself in the shoes of a buyer, which is, what are you looking for when you want to buy a book?
I want to pay the lowest multiple.
Haggling again.
No, but that's just it, right? Because everyone right now, there is some crazy numbers flying around.
Totally.
So everyone's going in wanting to sell at that number, right?
The main thing that people are concerned about or are most careful of when purchasing a book, I would say, is clawback. Clawback multiple, or understanding how many clawbacks have happened as a proportion of the book in the last 12 months, I would say is probably the key. That is the key driver on this, because you're really able to see at that point what sort of broker is this broker. Low clawback, really good indicator, probably strong relationship with the client. High clawback, probably not a great or as good relationship with the client, potentially acquiring the clients from somewhere else, referrals, something else, write the loan, don't really call after service, not a lot of love, they'll move quickly. The clawback is a really good indicator to understand how close the broker is to the underlying client book, is what I would say. That's the first thing. We will look at a multitude of things when we're valuing a book. We look at clawback. We look at the types of lenders being written. Obviously, if you're selling a book, you're going to buy a book of 100% CBA before you're going to buy a book 100% Liberty, Pepper, Latrobe, for example, second tiers, for example. We're going to look at impairment, which is the proportion of loans that stop paying because the underlying clients are in arrears, for example. We look at runoff, obviously, how long they stay on the book on average before they disappear. If they're rewritten, do they rewrite onto the same book, or are they running off into another portfolio somewhere else? These are all the metrics that we look at when we're valuing a book, and then we'll assign a score to each one of those factors, and then we'll multiply them all together to create a valuation. That's how we do it.
Yeah.
And ultimately, they're basically the things that you should be doing as well. But I would also be saying it's not purely the numbers. The second bit, I would say, that's probably even more important than that is, as I said, your ability to hand over the portfolio, which is, are you going to get a warm handover, or are you just going to get punted over? If you get punted over, you can imagine, right? If I've bought your trail from somebody else, let's just say, so like as in your home loan, let's say, call you up. Hey, Dien, how are you? Yeah. Who's this? Oh, my name's Jack. I run this brokerage. How's your loan? You need your loan? What's going on in that? You're like, all right, who are you? And why am I talking to you about something that's pretty intimate to me, which is my financial situation? You're a stranger on the phone. You expect this person to let down their walls for you such that they will let you rewrite their loan for them, give you your ID documents, all that sort of stuff. Like, they don't even know you.
Yeah.
Right? At which point, even if you've had a call or an email or something somewhere where whoever's sold your book over, goes, "Hey, Dien, just to let you know, I'm exiting the business. Pass your details over to Jack. Ripping guy. He does all of these things. This is his experience. This is why I'm convinced that he's going to be good for you and why he's going to look after you. If he calls you and you need something from a lending perspective, really highly suggest that you speak to him. I now call you, at which point you go, yeah, okay, I know this guy. I know that he can do what I need him to do, and I trust him with my information as well, at which point you're in a far better position. See, that warm handover, I would say, is worth way more than any, number that you're looking at in terms of like what the trail book is doing from a clawback, impairment, lender type perspective. I would say that is absolutely critical in these things, which is the structure of the handover from the old broker to the new broker, I would say is the most important part when you're selling these books and when you're buying these books and the multiples that you're paying.
Yep. So to move the because I love for the psyche of the industry as a whole to go, okay, right, I think books are now above 3. And so I'm all for this, because if it's going to mean that the book's values are going up, then we need to shift our own thinking in terms of what a book is supposed to be valued at. Because I joked before, I said I want to pay the least that I can.
Yeah.
But the reality is I need to be able to psychologically move that.
Agree.
What that amount is, right?
Agree.
Yeah.
And the market's the market ultimately at the end of the day. Like, what are these things worth? The reality is, as we said before, they're worth what someone is prepared to sell it for and what someone is prepared to buy it for. That's ultimately what they're worth at the end of the day.
Yeah.
And in terms of like what we're seeing out there, as I said, like decent books probably sitting between 3.2 to 3.7, I would say, is probably the midpoint, I would say, on all of these. So if you're capturing at those sort of values and you're getting the correct handover, you're structuring them correctly. Another one that we've seen is potentially, maybe some you pay in tranches, for example, which is you might pay 80% up front. You pay the remaining 20% after 12 months. And then the remaining 20% is less any clawbacks incurred over the 12-month period, for example, is another structure that we see that works as well.
Okay.
And with us, we're able to fund it that way. We're happy to fund 80% up front, and then we can fund the remaining 20% at 12 months. We do a reassessment at that period, super easy, super quick, take you 10 seconds. We can advance funds in that scenario because all the security's already there, everything's done. We can advance money by the end of the day.
I didn't know that either, so that's something new as well.
So
I came into this chat going, okay, just buy a book, borrow money, buy a book, that's it.
Yeah.
Yeah.
So there's so many complexities. What I would say on all of these things is like we're pretty good at these. Call us. We're pretty good at understanding the best way to structure these. We're quasi sort of kind of inadvertently become consultants on this sort of stuff. Like there's a couple of people that call me every couple of weeks. They're like, "What about this? What about that?" And I'm like,
Yeah.
Should really be charging money for this. But
well, it is a journey. I mean, at the end of the day, it's like this is the top of the funnel. I mean, the brokers need to change their mindset too, because you're in a business to grow and to sell it for a good price.
yeah,
No one's like a bit where that you might edit this out, but for shits and giggles. And there's a lot of entrepreneurs that come into the industry. I mean, not just industry, but every industry. But unless you've got the right systems, process, and the right guidance, and you know what you want to do next, you're not going to succeed.
Yeah, no, absolutely agree. If you are having a look at these sort of transactions, what I'd recommend is you give us a call if you do want to call. We still have a phone number for people that don't use the internet, which is 1300 112 999. I'm impressed that I remember that. Is the first
There you go.
And then I should have paid for it, so I should remember it. And the second thing is I'd log on to Co.Credit.com.au. If you go through there's a whole lot of resources that you can look at. The first thing is you can download a calculator, which is an Excel model. Shows you what your business would look like before and after an acquisition. That's nice to play with if you haven't actually considered it before. There's also a whole lot of resources that you can download, which just basically goes over everything that we've talked about here, which is the benefit of it, how it works, how you actually do it. And then you can also go through there. If you sign up, you've got the ability to value your book and sort of kind of put some more edges on how it will look for you. And from all of that, and if you give us a call or whatever, you can learn it all, you can understand it, and we're happy to help you guide through that process. We, as I said, it won't be us that slows you down. We can advance these in 3 days. It's generally, some changes with the aggregators as they're moving the clients and the trails over and that sort of stuff that will usually slow you down. But we can turn around book acquisitions in a couple of weeks with the aggregators when they're ready to actually move the trails around. And as I said, if working capital and stuff like that, we can get them done in a couple of days. It's super easy, super quick.
Yep. Almost at end of financial year too, so
we're busy for that.
Yeah.
Yeah.
Mate, thank you for your time.
Thanks so much for having us. I really appreciate it.